Index funds versus ETFs. The truth most financial advisors won't tell you. Here's a question that trips up almost every new investor. What's the actual difference between an index fund and an ETF? And more importantly, which one should you actually buy? You've probably heard both terms thrown around. Maybe your 401k offers index funds. Maybe you've seen people on the internet talking about VOO or VTI. The financial media treats these two things as if they're completely different animals. Some people swear by one, some by the other, and most people are just confused. Here's the thing. The debate between index funds and ETFs is one of the most overblown arguments in personal finance. In this video, I'm going to cut through the noise, explain exactly what each one is, show you the real differences that actually matter, and tell you which one to pick based on your specific situation. And at the end, I'm going to share the one thing about this debate that almost nobody talks about, the thing that could actually cost you real money if you get it wrong. Let's start from scratch. What is an index fund? An index fund is simply a fund that tracks a market index. A market index is just a list of stocks, like the S&P 500, which is a list of the 500 largest publicly traded companies in the United States. When you buy an index fund that tracks the S&P 500, you're buying a tiny slice of all 500 of those companies at once. The key word here is fund. An index fund is a pooled investment vehicle. You put money in, and the fund manager uses that money to buy the underlying stocks according to the index. Your money gets combined with thousands of other investors' money, and together you all own a proportional share of the whole portfolio. The index fund was invented by John Bogle, the founder of Vanguard, in 1976. Bogle's insight was radical for the time. Most professional fund managers can't consistently beat the market after fees, so why not just buy the whole market at the lowest possible cost and hold it forever? He was right. Decades of data have proven it. The S&P 500 has returned an average of about 10.5% per year since 1957. After fees, over 90% of actively managed funds underperform that benchmark over a 15-year period. Bogle's idea was so obviously correct that it fundamentally changed the entire investing industry. What is an ETF? ETF stands for Exchange Traded Fund. Like the name says, it's a fund that trades on an exchange, just like a stock. The first ETF in the United States launched in 1993. It was called SPY and tracked the S&P 500. Here's where people get confused. An ETF is not a different type of investment from an index fund. An ETF is a different structure, a wrapper that can contain almost anything. An ETF can hold stocks, bonds, commodities, currencies, real estate, or even cryptocurrency. Some ETFs track indexes, some don't. When people compare index funds and ETFs, they're almost always comparing two specific things: a traditional mutual fund that tracks an index versus an ETF that tracks the same index. Both are tracking the same index, both hold the same underlying stocks. The difference is entirely in how they're structured and how you buy them. Think of it this way. Index fund and ETF both describe the inside of the investment, but they answer two different questions. Index fund tells you what the fund holds, ETF tells you how you buy it. The real differences that matter.
A traditional index fund is priced once per day after the market closes. If you put in a buy order at 10 a.m., you get the price calculated at 4 p.m. An ETF is priced in real time, all day, just like a stock. You can buy and sell an ETF the moment the market opens. For most long-term investors, this difference is basically irrelevant. You're holding for years or decades. Whether you get the 10 a.m. price or the 4 p.m. price on the day you buy doesn't move the needle at all. But if you're the type of person who would be tempted to trade in and out based on market swings, the ETF's intraday trading can actually work against you. Difference 2. Minimum investment. Many traditional index funds have minimum investment requirements. Vanguard's VTSAX, one of the most popular total market index funds, requires a minimum initial investment of $3,000. Fidelity's FXAIX has no minimum. Schwab's funds vary. ETFs have no minimum beyond the price of one share. VOO, Vanguard's S&P 500 ETF, trades at roughly $550 per share right now. But many brokerages allow you to buy fractional shares, so you could invest as little as $1 in an ETF if you wanted to. If you're just starting out with a small amount of money, ETFs are often more accessible. If you're investing through a 401k, you're almost certainly buying traditional mutual funds, the index fund version. Difference 3. Expense ratios. The expense ratio is the annual fee you pay to own a fund, expressed as a percentage of your investment. This is where the numbers get interesting. Vanguard's VTSAX index fund has a 0.04% expense ratio. Vanguard's VTI ETF, which tracks the exact same index, has a 0.03% expense ratio. That's a $1 difference per year on a $10,000 investment. Fidelity offers zero expense ratio index funds, literally 0.00%. Their FZROX and FZILX funds charge nothing at all because Fidelity uses them as loss leaders to attract customers. The bottom line on fees. They're so low across the board on major index funds and index ETFs that the difference is negligible for most investors. What you want to avoid is the actively managed fund, charging 0.75%, 1% or more. That's where fees actually destroy your returns. Difference 4. Tax efficiency. This is the one that most people miss, and it's the most important difference for investors holding money in taxable brokerage accounts, meaning not a 401k or IRA. When you hold a traditional mutual fund in a taxable account, the fund manager may have to sell some underlying stocks during the year to handle redemptions from other investors. When they sell stocks at a gain, that gain gets distributed to all shareholders, including you, as a taxable capital gains distribution. Even if you didn't sell anything yourself, you could owe taxes on gains you never chose to take. ETFs are structured differently. Because ETFs are bought and sold on the open market between investors, the fund itself rarely has to sell underlying stocks. This makes ETFs significantly more tax efficient in taxable accounts. If you're investing in a 401k or Roth IRA, where your investments grow tax-free or tax-deferred, this difference doesn't matter at all. But if you're building a taxable brokerage account, ETFs have a meaningful tax efficiency advantage. The contrarian take. Here's the thing the financial media almost never says out loud. For the vast majority of investors, the index fund versus ETF debate is a complete distraction. You know what actually determines whether you build wealth over the next 30 years? Whether you invest at all, how much you invest each month, whether you stay invested when the market drops 30%, whether you keep your costs low, whether you diversify properly.
Choosing between VTSAX and VTI is like arguing about whether to paint your house light beige or slightly lighter beige. It matters at the margins, but it doesn't determine the outcome. The investors who actually build wealth aren't the ones who optimize their fund structure. They're the ones who started early, automated their contributions, didn't panic sell in 2020 when everything dropped 35%, and kept adding money through every market cycle. That said, here's the practical guidance. If you're investing in a 401k, you don't choose. Your plan offers what it offers. Pick the total market or S&P 500 index fund with the lowest expense ratio available. If you're investing in an IRA at Fidelity, consider their zero expense ratio index funds, FZRX for U.S. market and FZILX for international. You can't get cheaper than free. If you're investing in a taxable brokerage account, lean toward ETFs like VTI or VOO for their tax efficiency. The Vanguard and Fidelity versions are essentially identical in what they hold. If you're brand new and just want to start with as little as possible, buy a fractional share of VTI or VOO at any major brokerage. You can start with $50. The big number. Here's what actually matters. If you invest $500 per month into an S&P 500 index fund or ETF starting today,
and you earn the historical average return of around 10% per year, here's what you'd have. In 10 years, approximately $100,200. In 20 years, approximately $382,000. In 30 years, approximately $1.13 million. You started with $500 a month. After 30 years, you contributed $180,000 in total. The market turned that into $1.13 million, $950,000 of pure compound growth that you earned without doing anything except not touching it. That's the game. Index funds and ETFs are just the vehicle. The driver is time, consistency, and the discipline to leave it alone. So here's your action step. This week, not next month, not after you do more research. This week, open a brokerage account if you don't have one. Fidelity and Vanguard are both excellent. Put in whatever you can afford. Buy VTI or FCRX or your plan's total market index fund. Set up an automatic monthly contribution and then go live your life. The best investment decision you'll ever make isn't picking the right fund. It's making the decision to start. If this video helped clarify the index fund versus ETF debate, hit like. It helps more people find this content when they're searching for answers. Subscribe for more straightforward personal finance content every week. And drop a comment below. Are you team index fund or team ETF? I read everyone. This is Market Vault Media. We'll see you in the next one.